everyone, and welcome to our session on European competitiveness, the new challenges. We have the pleasure of having a very high-level group of policymakers and, of course, a very good chair. Reinout has kindly accepted to share the session today. He will introduce briefly our guests and our speakers. All the bios are on our website. Reinout, thank you very much. Over to you, and I also take this opportunity to thank governors for accepting our invitation, Sir Jonathan Hill and Debora also for taking the time to be with us. Over to you. Thank you.
Yes, hi. Thank you everyone for joining. I think consensus formation is not always very easy in Europe. There's a lot of divergence in general. But I think there's been an emerging view, consensus, that Europe is lagging, and really in different dimensions. On investment, we heard that earlier today at the panel on global growth, on growth as well compared to the US. Energy supply and cost has been an issue. Defense, most recently, very important. And then also still this long-term issue on capital markets and how it compares to the United States, for example. So the goal of this panel was really to try to touch on as many of these angles as possible. We have a Bank of Portugal Governor Centeno, Bank of Lithuania Governor Šimkus, Jonathan Hill, who many of you know when he was at the EU Commission on CAP, and we've been very vocal on definitely the financial dimension. And then Debora Revoltella from the European Investment Bank. Governor, I would think that maybe we can start with you because you've Governor Šimkus, sorry. Yeah, sorry.
Too many governors.
Too many governors.
No, too many, no, only two.
You haven't been in governing council.
Okay,
yeah. Many more of them.
I don't know. How do they do it? Is numbers? People get numbers? Or like,
No. Please.
So would you like to share some thoughts on Lithuania's experience recently and how you see the European challenges?
Yeah, probably I will focus more on European challenges, but let me begin thanking for this invitation to talk on this very relevant topic. When we consider weakening of growth in medium term, I think it's a global phenomenon relevant not only to European Union, but in Europe it's even more acute, especially when our economies were hit by substantial and I would say a series of supply-side shock in relation to the geoeconomic fragmentation which is gaining momentum. And this of course requires a serious and collective and ambitious response because the challenges stem from a number of factors such as demographics, such as slow productivity growth, geoeconomic fragmentation, need to reduce the energy dependence and move away from fossil fuels. I know that there are many pessimists all around the globe about Europe and its competitiveness and productivity, but I would call myself as a cautious optimist, and I think what fits for Europe very well. So, such a saying that when there is a will, there is an action or something like this.
There's a way.
There is a way, exactly. But a way is always with an action. So strategically, when I think how to make, I will be more specific in a second, but strategically, how to be, or actually tactically, how to be, so to say, successful. I think to make use of the features what the European Union is, and we need to build upon our strengths and to minimize our weaknesses. So what is the European Union? It's an area of free movement, labor capital, goods and services. So when I say to build upon our strengths, is to build upon, actually is to deepen the single market that's in the essence of us. And also, when I mean this, I mean also the completion of the capital market union and banking union. When I say minimize the weaknesses, I mean by this, these weaknesses that were revealed quite recently by some of the supply shocks. And in particular, Russia's unjustified war against Ukraine. And then something that Europe thought it's one of its strengths appeared to be its weakness. Its dependence on energy supply and diversified sources of energy supply. Now, let me be a little bit more specific. And first of all, the key is to avoid fragmentation and trade distortion policies within the single market. What the IMF study shows, so the number of trade distorting subsidies actually with a single market not decreased, but increased in the last 2 years by almost 70%. And only in only in 2022, members spent almost 400 billion euros just on the energy subsidies alone. Why it's important? Because actually it distorts fair competition and this improves resource allocations when member states provide those subsidies. So withdrawing these national subsidies in the single market, I think it's very important. Second is to further deepen market integration, and trade integration in the EU is from 2 to 3 times lower than the US. And then again, I will refer to the IMF study. The IMF study shows that if EU reduces internal barriers by 10%, this would lead to 7% increase in real income and in the long run. Then I mentioned the European Union as an area of free movement of labor, but there are barriers to labor mobility that could be lowered. And then again, the study of 2021 made by Head and Mayer shows that find that frictions that prevent labor mobility within the European Union remain very large. I know that my colleague Mario will disagree because I know some of his arguments about labor mobility in the euro area and how it is compatible to the US, but workers' cost of migrating between the EU countries is about 8 times higher than the migration between the US states. So even if I say, if I believe and I'm a huge supporter of the single market, I see that the single market, we still have areas to improve and by this to enhance our growth. And I also mentioned completion of the banking union, completion of the market, of the capital markets union. What regards banking union, so of course, Europe is the bank dominating financial industry. So having this real banking union enables more efficient allocation of the bank funding to the European companies, but also the capital market union. Because I would mention just 3 priorities that in my eyes are like real priority. The first thing to do, so creation of a single rule book enforced by unified supervisor, and then to harmonize corporate insolvency rules as well as to address the debt bias in taxation. Okay, probably I'm taking too long, but
no, it's very useful. Maybe I can just ask one question before we move on. I mean, how do you see the role of the ECB here? I mean, this is I think this week has been definitely U.S. bond market is in focus. U.S. real rates have gone up, but U.S. has also had the buoyant equity markets, higher growth than Europe. Europe is having some spillover in its bond markets. We've been arguing in favor of divergence, but you've seen the spillover last year, but not the same kind of boost in equity markets and growth. So what is the role of ECB in sustaining some of this?
The role of ECB is very important in all this, but the importance stems from the mandate the central bank of the euro area has. This is to maintain price stability. Why? Because only in the, so to say, stable environment, we can ensure the growth of real income of people, we can ensure the robust and stable macroeconomic environment, we could ensure the resilient economic environment in which is required for the investments to grow. So I wouldn't, ECB is not targeting interest rates, let's say, neither in the euro area as such or in any other single euro area country, but the importance of the central bank comes from the ensuring or fulfilling its mandate and also making or ensuring the stable conditions in the financial markets, which of course is very much interrelated with the efficient monetary policy.
Thank you. Governor Centeno?
Yes, thank you. Good afternoon, and thank you for having me. Let me give a complementary, not opposite, but complementary
Let's make it
view.
more interesting.
Yeah, I'll try. And view on Europe. And let me start by the incredible crisis that Europe had to face. Most of them were shared with the rest of the world, but in many dimensions, they were more acute in Europe. And I think the way Europe reacted to those crises, to the COVID crisis and then the inflationary crisis, made Europe the biggest pillar of stability in the world. We did not went through fiscal indiscipline and tons of euros or dollars sent to our economies as, and it's very simple to compare us with the US. The difference between the deficits, the fiscal deficits between the US and the Euro area in the last 4 years is close to 20 percentage points of GDP. This is a huge, huge amount of money. The same thing is true in terms of our monetary policy. The inflationary process in Europe was mainly supply driven, and the cautious with which the ECB designed its battle against inflation took that into account at any moment in time, and we measured our action with such a degree of success that today we have an inflation very, very close to 2%. It's the last number is 2.4. We forecast inflation to be below 2% in a few months' time already this year. Then the road is a little bit bumpy, but I can only imagine someone saying that inflation has a bumpy trajectory of someone that never looked at an inflation time series. I mean, there's no other time series more bumpier than inflation. It is a backward-looking indicator. Every base effect stays there for 12 months. So I wonder why we now look at this and freak a little bit about 0.1 percentage points of difference. The fact is that we have been successful. It's not only a matter for the ECB, and we knew that from the beginning. It was a big test for Europe. And one of the biggest tests that we faced this time around in Europe was how would the labor market react to this? Because historically, we are known as a sclerotic labor market. What is a sclerotic labor market? A market that takes a long time to adjust, to go back to the initial point. And Europe, in Europe's labor market, took only less than 1 year to get to the level of employment of pre-COVID. We continuously expanded the labor market, both in terms of the employment numbers, but also of the rate of participation in our labor market, activity rate. It is at historical levels. We made this with a substantial difference in composition, both in terms of employment and unemployment. We now in Europe create a number of jobs that is very similar to the number that the US creates every month, every quarter. This is unique. We didn't have that. If we compare the number of new jobs in Europe today with the numbers of pre-COVID, they are 25 to 30% above. Unemployment composition, the same story. We used to be known for our long-term unemployment, long duration of unemployment. So it is reduced now by more than 25 percentage points vis-a-vis the pre-COVID period. Unemployment insurance, the labor market in Europe was always described as one in which protection is very high. Well, we now have a share of insured unemployed that is at its lowest levels in this century. So we need to take that into account to understand the biggest success of Europe, which was we didn't generate in the labor market wage pressures that put into question the disinflationary process. That never happened through this process. We are now, with the latest numbers we have for wage growth already for 2024, first quarter, signed agreements 3.2%. When those agreements were signed, our forecast for inflation in the euro area was above 3.2%. So those agreements were signed with losses in real terms. Actually, real wages loss in Europe amounted to 7 percentage points. This didn't happen in the US. So the euro area showed a much higher degree of real wage flexibility than the US. This is all new. I understand that you are staring at me, where does this guy come from? I come from Europe, and the labor market in Europe today is able, we can say with a high degree of certainty, we need to continue evaluating this, that it completed one of the pieces of the puzzle of an optimal currency area that since the beginning, the fathers of the euro area idea were beaten very, very heavily because it was not an optimal currency area. And one of the questions was precisely on this issue on the labor market. Well, the news are, we are getting there. One number that I think probably concludes this part on the labor market. After COVID, we put 10 million jobs in the euro area. Never ever before we had such a strong increase in jobs. Half of those jobs, 5 million, are held by people that work in a country different from the country in which they were born. 50%. This never happened in Europe before. Mobility, labor mobility, social mobility in Europe today is taken very seriously. This is the result of more than a decade long of reforms. The OECD has a very nice report in 2021, Employment Outlook, where they review these dozens of small reforms that we don't notice. But these are the wisest reforms that we can do. They act at the margin, they take time to produce effects, but eventually they prove right. And that's the story of Europe recently. So I think it was a collective success. Of course, we have to pay a price for that. And unfortunately, the price is that we are having a soft landing, but maybe the US is having a fast recovery. I don't even know if they landed, because the US economy, which is good for the US, proved very, very resilient, and the price to pay for this inflation, and I'm hopeful that the inflation in the US really approaches 2% soon, because we need this to be a global phenomenon. It is occurring in Europe, and the price is, and it is very high, believe me, it is very high. I also don't understand these people that say that we don't have any sacrifice in Europe. We do. 3 numbers. 0 growth for 1 year and a half. Last quarter 22, first quarter 2024. I don't know what's going to happen in Q2. Maybe we keep extending this very bad record. It's not a recession, but now compare it with the US. It is a price. Why is this? Investment. Despite the Next Generation EU projects that are centralized, unique, financed by common resources, by common debt in Europe, first time ever we have a safe asset in Europe. This is of huge value for Europe in the future. We were lacking this compared with the US. Well, now we have it, and we have to take good care of it. But despite this, private investment in Europe is falling. In 2023 and 2024 together, total investment will be stagnant. So we will start 2025 with the same level of investment that we had in 2022. This is not good. This is nothing, no good news to productivity or growth in the future. This is the price we are paying. And we are a society, as Gediminas said, an economy that is heavily dependent on banks. So now let's look at credit, the third indicator. Credit over GDP today in the euro area is at the lowest level ever recorded in euro periods since the euro creation. This is not good. This doesn't signal good prospects for Europe. So we have to turn this around. We have to risk. We have to take risks because we need also to be good at taking risks as other economies do, namely the US. So that's where I think the decoupling must be taken the other way around. Our economy is decoupled, so the decisions by the Fed and the ECB need to focus on their own mandates, and our mandate is very clear. It's on the inflation. Yes, inflation is converging to 2%. Yes, the so-called, the mysterious last mile will occur because there is an asymptote. It is obvious that converging to 2%, the steps will be smaller and smaller. If we continue to reduce inflation at the same rate as in 2023, we will be having deflation today. So if you converge, it's a very basic arithmetic or mathematic, if you want, concept. If you want to converge, convergence is exactly that. So I am very optimistic as well. I think we will be able to do it in Europe. We are doing it very, very efficiently, but with a cost, and we need to recognize it. Thank you.
Thank you. That was actually going to be my question, because hearing you about the labor market is very encouraging, especially given, I think with clients, we still get questions on wage inflation spillovers.
I call it a dividend. I think Europe is living out of a dividend from the labor market. And we need to, as all dividends, we need to take it with good care. We need to promote it. We cannot destroy. I also heard the previous president of the Australian Central Bank saying that they need to protect the gains they achieved in the labor market. This is perfectly put also for Europe. Europe cannot destroy the successes that it had in the labor market. And this is a dividend, and it is paying out huge amounts of credit for our economy, because employment keeps going up, unemployment is very low. I don't think that this will last much longer if really the economy doesn't pick up. Firms are not charities. So I don't believe the labor hoarding theory. I don't see any reason why the concept of labor hoarding can be used in this context. It is truly a sharing mechanism from the side of firms with workers, and helped a lot by the policies that were implemented during the COVID period in Europe as well.
Thank you. Sure. Debora, the view from the European Investment Bank.
Thank you, and it's difficult to add something completely new. So I try to I try to follow. Actually, I'm convinced, cautious optimist. So I follow the path that we had before, and I will try to build the story around this cautious optimism. I think we are coming, and it was already said, from a very much more severe term of trade shock in Europe versus the US. We managed the soft landing post the energy shock, avoiding recession. But I think the real plus that I've seen in the last years, and probably also for the viewpoint that I have from the institution where I am working, the real part was that a big part of the policy response was also associated to keeping a transformation and the transformation of the economy and competitiveness as the main leitmotiv. Partly was the Recovery and Resilience Facility, but at the end what we have seen is that all countries in Europe, almost all countries in Europe have kept public investment going, not only public expenditure in general, but the investment component with the transformation component associated. And private investment has followed in some countries, in other less. But overall, we have also seen that countries that traditionally had suffered much more in terms of growth, some of the southern countries are actually doing quite well. It may be a part of spending, but on some countries you have surprisingly strong data in machinery and equipment and intangible investment. I speak about Italy. The data are the best that you have seen in many, many years. And hopefully this will have some effect in terms of productivity on the corporate side. The other point that is coming actually in the policy debate, there are not only policy debate, but also in the policy dialogue at the European level, there are two work streams that are coming up. One was just presented yesterday or 2 days ago. I got 2 days ago. I got lost with the traveling, and it's the Letta report that is looking on the single market. And the second one is the report from Draghi on competitiveness. I think that these two reports will actually push once again Europe in the right direction to think about transformation and what to do more. It's an opportunity, but I am cautious optimist on that point of view. Then that's part of the optimist side. Still, we have issues in terms of competitiveness, and I think in our work we have detected actually from the global financial crisis and the sovereign crisis, something that we call a gap in terms of productive investment. Productive investment is machinery equipment, intangible infrastructure. We take out the residential real estate, and you see a gap year after year of 2% of GDP EU versus US. It's a long period of time, and it's accumulating year after year. It's really a matter of capital deepening, and it's something that the good part of the story is that post-pandemic you didn't see that much new gap emerging. Actually, investment was going, but on a longer period of time, 2% year after year, it matters. There is a lot of discussion also in terms of what's happening to per capita GDP convergence or divergence and the role of the US economy on the world. I think we have been looking at the number like many others, but if you look at per capita GDP at constant prices, what you see is that since the 90s, you have a gap EU-US in terms of per capita GDP, constant prices. But over time, the gap doesn't close and doesn't widen. So it's a partly good story. A lot of people say Europe is dramatically diverging. No, it's not converging. And I think there is a lot also on this capital deepening part that is affected, but we don't see this big divergence coming up. So this is a part of the negative story. I wanted to say a couple of other slightly positive things. I think in the global context, we are in an incredibly difficult moment with you can call it in many ways, the globalization, fragmentation, etc. I think Europe, with all the difficulties, is trying to keep at least a consistent answer on a couple of elements. Once on Ukraine, we it's extremely difficult still, but we managed to put the resource on the table. So this is something Europe is playing at least as it can part of its global rule. And also on decarbonization, at the end, we have a binding regulation for 2050 in terms of decarbonization commitment. We are on the process for the 2030 target. It's difficult. There are a lot of backlash, but I think we have taken a very strong commitment in this direction. So if we have to talk about a country with all the complexity of the moment that is still playing is a global rule, I think Europe is doing it. Then going back to policies, I think the list of priorities is extremely important. I think the reports, particularly the letter report on the single market, is making a lot the case of competition, a lack of competition in the market and fragmentation of the market. I think it's very interesting. He makes the example of telecom companies, and those are extremely difficult things. I think it will call a lot of intra-EU really protectionism, maybe we can call it. But if at the end we end up tackling this, I think will be extremely important. Capital Market Union, again, is the same, the same stories coming back. I think we have both we have the usual story whether Capital Market Union means deep domestic capital market or integrated market. And I think there it's an answer that we will have to find. And I think there is a strong case for more integration, but is still in the discussion phase, particularly in some of the smaller countries at the European level. There are a couple of other policy priority. We have a lot, and also as an institution, a lot of the focus on the innovation side. On innovation, and particularly on innovation, we all know that Europe was never fantastic in terms of innovation capacity, but on the green innovation side, there is some opportunity. It's very much challenged, particularly on the Chinese side. We think that there is very important work to be done, particularly in the scale-up phase of firms. And what I see is that there is a lot of alignment now that this is an important area of action. We as an institution are working both on the equity side for the scale-up initiative, the European Champion Initiative, and we are doing more and more of we call it first of a kind industrial development support. And I think that's the very nice way to put, if we really have to go, and I think we will have to go on the way of industrial policy, this is what you should try to have. So really projects that make the difference in the industrialization of green technologies, and something that has a demonstration effect. And probably it's the best way to go without too much interference in the industrial policies. The last point I want to mention is on the decarbonization side. I think, again, it's a very difficult story. While it's easier to go on incentives for the green economy, I think it's difficult to go on tackling the hard to abate or the high energy intensive industry. Europe is following the path of the carbon pricing, and with all the back and forth, you can say everything, but it's working in the sense that carbon prices in the ETS over time, and there are moments of peaks and downs, etc., but over time, it leads companies to invest, innovate, and transform. So there is a path also on the brown part of the economy that is transforming. It's something that without carbon prices is very difficult to achieve. You develop the positive side of the economy, but not the decarbonization side. And the very last, I very much agree on the skills as a top priority at the European level. And I think on the skill part, there is, in Europe, there are many things. There is a lack of skills, but also a lack of people. And there is, if you want, an opportunity in terms of labor force participation. We are at, probably in many countries, we are at peaks of labor force participation over historical peaks, so it's growing, but we have still a lot of room for improvement in an international comparison. And particularly, we were monitoring two data that I have in a slide that I normally show. One is the drop in participation of women if they have kids. After one kid, drop. After 2, 3 is dramatic. So it's really calls for childcare expenditure, something like kindergarten, whatever you call it. But that's something very important on labor force participation. And the other one is if you look at the PISA score in mathematics for kids around 15 years, depending from whether they come from a rich family or less advantaged family, it's really different. So again, it calls for dealing with the support for the low-income family kids in terms of education. And with that, I close.
Thank you. I mean, just listening to you, the investment needs are pretty high in Europe the next decade. And the IMF has been warning about, also yesterday, high debt levels, potentially higher rates globally. How do you see this? One focal point of clients has been these new fiscal rules. Will that not, to some extent, limit how much countries can spend? And there's talk of the EIB doing more defense investments, etc., or funding more defense investments. So how should we look at this? Is there a contradiction there between the very ambitious agenda potentially from Letta and Draghi compared to what the fiscal space is that countries will have?
I think the fiscal, so like many things, the fiscal rule are a compromise solution, and they are there, and we have to live with the new fiscal rule that are in place. There are various studies looking at whether they will generate too much consolidation, etc. I don't enter into that, but the main point that I have is that many times it's also a matter of choices on the public sector point of view on the composition of expenditures, and you need some kind of prioritization of public investment to stay, and the part of the public investment that you need for the transformation. It's also true that first of all, what we see in this moment is that with a lot of resources in this current moment associated to recovery facility, EU funds, etc., the binding constraint is not the financing side, but the implementation capacity on the public sector point of view. So that is one area where I think we need to do a lot at the European level. And then the second part is that with all the investment needs, you cannot expect everything to come to the from the public sector. You really need to find instrument to call in the private sector, and that's where capital market union is very important.
Up to you, Jonathan.
Okay, thank you.
Thank you.
Well, first of all, I should say to all my European friends on this panel, I hope they will forgive someone from a third country presuming to express views about Europe. If it's any consolation, Britain, which many people thought when it left the EU would become more American, I can promise you we've become much more European. It's one of the many paradoxes, and some of the issues that we're describing we face in exactly the same way in the United Kingdom. I thought what I'd do, with your permission, since we've got onto the Capital Markets Union, and I was the fellow who had the first attempt at the Capital Markets Union, or a version of it, back in 2015. And I thought it might be helpful to say, as an outsider, what I think has changed since 2015, what I think is still the same, and what I think, having read that report from Enrico Letta, which I thought was an extremely interesting, powerful report, but where I think there are still some gaps that Europe needs to address. So in terms of what's changed since my time in Brussels was rudely cut off in 2016, the basic assumption, I think, of how we thought about the world and how we thought about the place of regulation within that world was that the EU and the US were like broadly going toe to toe, head to head. And we talked about ourselves in those terms, and I think that's how we thought about our place in Europe, in the world. And I think the vision was based on open markets, free trade, underpinned by convergence of global rules. And I think Europe thought that its ability as it would describe itself as a regulatory superpower, would give it advantages in setting the rules within which it would then compete. So it would help its competitive position. I think if you look at it today, that assumption has changed quite a lot, and it's already been touched upon the extent to which, on certain metrics, the gap, there have been some good counterbalancing arguments, but I think the core analysis that on some basic points of competitiveness, whether that's on the size of the economy, for instance, the state of our banks or the performance of our financial services. If you go back to 2008, Europe was bigger than the United States, and now on a number of those things, we're clearly not. So I think one has to start from that change. And I think the other thing, which has already been touched on, that the growing challenges that all our governments in Europe face, whether that's for defense spending or demographic change or the green transition, that the capacity of governments to respond to that change, either through borrowing more or taxing more, it's got harder and harder, and the ability of governments to tax citizens is, I feel we've pretty much reached the limit across all our economies, and you can see politicians struggling with coping with the political consequences of that. So I think that's meant that the demands for growth have become more urgent, because the only route really that is left is growth. And I think that's already a theme that is emerging. It's emerging from the Letta report. I'm sure Draghi will talk about it again. I think the second thing that's changed about the discussion around capital markets union and about the single market is that the level of political commitment to trying to make progress has changed a lot. It's ratcheted up a lot. So when I started on the Capital Markets Union, I would be struggling to get finance ministers to have much interest in it. And that was partly because it hadn't really been defined, partly because they didn't, in a lot of countries that don't have very developed capital markets, they couldn't quite understand what the relevance to their country was of this. And then also the deep-rooted suspicion that if some person in Brussels comes up with a proposal, it must kind of pose a threat to almost everybody. And I remember the discussions I had with my German colleagues who just automatically assumed that capital markets union would be a death threat to Sparkassen. So Sparkassen was the first word of German I learnt when I was in Brussels. And then once I went around and talked to all the Sparkassen and they realized I didn't want to destroy them, you know, it was okay. But I think the suspicion of some of those initiatives back in 2015 was definitely there. But I think the fundamental shift is that, as we've already heard, there are lots of people in the system who now realize there is an urgent problem, and therefore, if we're serious about addressing the problem, we have to be serious about addressing questions to do with the single market and the capital markets union. And that, to me, at a political level, the engagement of it has definitely, it feels to me now from the outside, has definitely shifted, and that is not without significance, I think. Third thing that's changed from a CMU point of view is that Britain has left the EU, and so London, if I put this kind of crudely in 2015 thinking, London, which was the natural place to form a centre for a European capital markets union, is outside it. And so the question then, which is always there within Europe, so I think the hopes that some countries had when Britain left, that one of them, not that far from Britain, across a fairly thin strip of water, would move quickly to replace London with a capital beginning with P. That hasn't happened. And so I think the problem that you still have, which is how do you overcome, I think there's a double challenge for Europe. There are the large numbers of countries who don't think they have any skin in the game on deeper capital markets. And then there's the smaller number of countries who do have skin in the game, and you then have to persuade the 5 or 6 of the bigger players to overcome some of their, you know, understandable national interest resistance. So I do think, as a factor that's changed, Britain not being in the EU, London not being in the EU, has made the kind of execution of it, because I do think logically it makes sense to crystallize something around one place. I think that has made it, I think that's made it harder. But I think the other point that's changed is that there's much more agreement in Europe as to what the things are you need to do. I mean, when we started, I think a number of people thought CMU was just like a political slogan and a stunt, and what did it amount to, and what were capital markets, and can there be such a thing as the capital markets union, and what's wrong with our banks? And I don't think that is true anymore at all. And so I think that's a positive thing from the point of view of the CMU. In terms of what hasn't changed, I think the fundamental point is delivering the CMU is still very difficult for some of the reasons I have alluded to, that getting some countries to think it matters, getting other countries to make sacrifices, and then you have to work out what you need to give them in order to compensate them for their loss. This is very difficult. Some of the issues you need to overcome, for instance, around insolvency law, where, you know, in countries, it was one of the problems, again, that I had. The ministers in charge of insolvency rules in individual countries are not finance ministers or prime ministers or heads of government. They're like interior ministers and justice ministers. And they're a very different breed of people. And if you have to get agreement from 27, or maybe with enlargement more, on issues where you can't see any economic upside, but you know that in your day job as an interior minister, it's a total pain, that's quite hard. And I don't think one should kid oneself that because there clearly is high-level political engagement, that the practical obstacles you have to overcome will somehow be magicked away. I think there are areas that you can make quicker progress. I mean, the area that we wanted to start with way back in 2015, it's still on the table, is securitization, where, again, if I had to guess, I think Europe will move quite fast on that. The problem that we had back in 2015 was not in the Council of Ministers. We got that proposal through the Council of Ministers in under 4 weeks. It was the quickest anything had ever gone through. It then just got caught in the European Parliament in an argument between the Socialists and the Conservatives over EDIS and the banking union, and it was collateral damage. But I think this time that'll be different. So, you know, if one's looking for signs, and is it serious? I think one sign is the amount of political commitment. The other is how quickly can they make some progress on some of these things. And so I'd say to you, look out for how they do on securitization. The other one, which has been touched on, the creation of a single supervisor and a single rule book, that's not easy. And you know, that will remain difficult. I just wanted to say, if I may, just a couple of things about something that I think has been missing a bit from the debate about growth and competitiveness. Although the governor did touch on it when you talked about risk. So I'm not a clever regulator or economist. I was just a sort of politician parachuted in to do a job. So I don't understand, you know, the ins and outs of economic policy as others on this panel obviously do. But to me, to start a conversation about growth without starting a conversation about risk seems to me completely illogical. I don't understand how we think we can have more growth if we don't increase our risk appetite. And I think in Europe, in my own country, the last 6 years, but it goes back beyond that, we've not deliberately, but fairly systematically been reducing our collective risk appetite. Not just in financial services, but in our whole attitude to a whole range of social and economic policies. And I think if one wants to have growth, we need to have, I think, a much more honest discussion about being able to increase our risk tolerance. Because what I think we've been promising for a long time, or is that everyone can have everything, and that in future we'll be able to have risk, but we'll be able to have growth, but there'll be no risk. And I think we should be honest about that. That links to me then to just a couple of comments on regulation and the growth of what you might call the regulatory state. So I may now be about to hack off my fellow panelists. So what I'm about to say is not an attack on regulators, it's an attack on politicians. I think there's been an extraordinary loss of self-confidence and the taking of responsibility by politicians for decisions that affect the well-being of our citizens. So everyone tends to think of regulation as just being a highly technical matter, and obviously there are aspects that are very technical, but ultimately it's highly political. Where we set our risk appetite, where we set our views on, for instance, capital requirements, those translate into jobs, savings, investment in small businesses in our regions. And we've constructed a system where politicians have surrendered responsibility. Regulators and supervisors are incentivized to be risk averse. I mean, that's their job. And if things go wrong, they then get hammered by the politicians, who also blame them for not giving you enough growth. And so I think that the question, if we want to increase our risk appetite, to me, takes one inevitably into questions about regulation, the boundaries between politicians and regulators, and questions of accountability. Because I think one of our recurring problems in all our countries is all our citizens are complaining about not being in control of their destiny, and they take it out on the ballot box because they can't take it out on anyone else, and then the politicians carry on doing more and more crazy things. So I think there is something around regulation that we should be looking at. I was very struck in the letter report. There's a whole chunk on regulation and the burdens of regulation. He goes much more broadly than financial services regulation. But given that I think making progress on the single market is a long-term job, given that I think making progress on the Capital Markets Union is a long-term job, I think there are some shorter-term things to do with reviews of regulation to try and increase a risk appetite and to look at the burdens in a comprehensive way, and in my view also to stop the burdening of regulators with ever more jobs and requirements to undertake. So the perimeter, the regulatory perimeter keeps going out, and the focus of supervisors and regulators keeps becoming diffused by politicians. And I think that is an area that if we want in Europe to talk about competitiveness, that in a calm and sensible way, we ought to start tiptoeing into.
Maybe, because you said that there's more commitment now, so that's positive. But otherwise, it seems quite pessimistic, your assessment. The sense that the EU is not the regulatory superpower it wanted to be. You have London as a financial center. There's no clear tool maybe to channel some of this. Are you more of a pessimist or optimist?
Maybe? I don't know. I mean, so I fluctuate, and then I come and listen, and I felt a bit more optimistic earlier, and now I've depressed myself again. I think so I do think there's been a big shift that no one's really got their head around, which is this point that regulation 10 years ago was seen as something that was in the future was convergence and cooperation across the globe. And I'm spending my time obviously coming over here, going to Japan, going to China, and we were all pushing in the direction of more cooperation. I think that regulation is a new front line of competition. I think there's just been a shift. And I think that's driven by the geopolitical shift. I think I'm not an expert on America, but it seems to me America is very focused on one thing, which is making sure it is fighting fit to take on the Chinese. And then what that then means for how it thinks about the vitality of its economy, how it thinks about the size of its businesses. I mean, we in Europe have, going back to what we were talking about before, our natural feeling on things like national champions of business, making businesses bigger and allowing amalgamation has been, no, we want to be on the side of consumers. We want as much competition as possible. I think that's shifting in Europe quite fast. I thought that was a very strong theme again in the letter report. But that old picture, I think, is broken, and one can regret that and think that's not terribly good. But I just sort of think that's the pattern for the next period, and therefore we can't. So I was asked to carry out a review in the UK on the position of the London stock market and what can we do to think about the competitiveness of London. And when you just start looking at what's going on in other markets, it was difficult for me not to conclude that we were doing things in the UK in a heavier, more intrusive way than was happening in well-regulated competitor jurisdictions. So I think if more divergence is likely to be the future, if there's a Trump presidency, I think that'll happen very fast. personally, but what do I know? Then I think it will be incumbent upon other economies to think what that means for them. And I think the assumption in Europe that where we have a particular problem with gold plating in individual member states, that you can carry on with the legislative sausage machine churning stuff out, and that we'll just make sure everything's like perfect. I think we should ask ourselves whether we think that's right in this new competitive landscape.
Thank you. We have 50 minutes for questions from the audience. Yes.
Jeffrey Smith from Politico. Very interesting choice of words just now, Lord Hill. That America is focused on being fighting fit. Do you think that Europe's problem is that it hasn't actually realised it's in a fight yet, as regards China?
These other guys on the panel, ought to answer, because I'm I'm not part of the European political system. I do think, though, that we were, when I say we, I mean the European system, was slower to catch up with some of the changes that were going on. But I also think all the signs are, and it's been confirmed here, but you just have to, just look at European politics, you can see it. I do think that Ukraine delivered a wake-up call. I did think, as an outsider, that the response from Europe was much more speedy, impressive, and coordinated than I feared it would be a couple of years ago. I think what happened initially with the Germans was pretty extraordinary. So I think my perspective is that the European institutions, you can see it from von der Leyen, you can see it from the others, they're on the journey and they're accelerating, I would say. My thing is, because I want Europe to do well, is, I just urge them to go as fast as they possibly can. But it feels to me that is what is happening. But I defer to others.
So, comment? Yes.
Sorry, for me, this is the point, isn't it? Because I imagine, Mr. Šimkus and Mr. Centeno, the Russian threat looks very different from Vilnius and from Lisbon, as far as the relative population's perception of it.
What was the question? I didn't hear the essence.
Is it a problem that for you that you feel that the European perception of the Russian threat, and whether it's something to be mitigated, contained, or just resisted and countered, there just doesn't seem to be enough unanimity on that.
If I can add my perspective as a representative of a country that has a border with Russia and Belarus, which is basically the same Russia. We have so many nice talks and support for Ukraine in Europe and the US. And in words, all democratic world stands and supports the Ukraine's war against the aggressor. And basically, the countries also, in words, try in a way express the willingness to enhance their defense capacities. But I kind of deliberately repeat the words, because to turn this into actions, something needs to change, actually to be realized in the heads. And like this real threat needs to be understood and realized. And only then the things turn into action and like real spending, for instance, in defense or in increase in defense. We have a lot NATO countries, but still, I think it's more than half of those, or almost a half, still spends 2% or less of their GDP on defense, even if all of us in words understand the threat. So that's a real threat. And let me touch upon another issue, the seizure of these immobilized Russian assets, which could be used, in order to support the Ukraine, Ukraine's military needs, or reconstruct or rebuild the Ukraine. And somehow we become so much bothered about the international role of euro. I understand there might be different views on that, and people might have different views. But for us, for me, it's not about international role of euro. It's the role of Europe. Because there is a bunch of countries actually sitting on the fence and watching how all this thing end up. And, without the sufficient support, the outcome might be disastrous. If Ukraine, I won't say if Russia won't win, but if Ukraine needs to win, because otherwise we'll have a real mess, I believe. We'll have a real disaster, and a real disaster for the democratic world. So, don't know if you answered your question, but I took this opportunity to express my views.
Well, this is the view from Vilnius that I support. So let me give you a different perspective and connecting with what Lord Hill said. It was my first reality check as president of the Eurogroup a few years ago. Europe was coming out of a very damaging debate around risk reduction. And then on occasion, risk sharing was also on the table. And I tried to collapse the two concepts under risk management. We needed to understand what sort of risk we were able to accept. And the only way to do that in a comprehensive conversation, in my view, as president of the group, was let's discuss risk management. But I failed. Okay, we had to continue with the same dichotomic view under risk reduction and risk sharing, and Europe really could not. By then, I think we made progress, as you mentioned, but we still face a difficult time finding out what sort of risk are we willing to take. This project of the international role of the euro was being prepared to be relaunched still under President Juncker leadership, and then passed on to President von der Leyen, and I was part of sort of an attempt to relaunch it, but then COVID came, and everything collapsed in terms of strategic view for this, and we had to look at other issues, which means that we still face today these global questions that you raised with no pocket money. We go to the debates with no pocket money. We have to go back to Brussels and put the 27 together to understand how much money can we have for this. And this doesn't help on making this specific view on Europe stronger. Again, I find very funny this debate about decoupling in monetary policy. Decoupling what? This has been our history, not even only recent history. Europe needs to find its place on the world, needs to follow that very strictly, and we have monetary policy of our own. We have diplomacy of our own, and we need to pursue those. And sometimes we fear to do it.
great. Yes. Daniel, yes.
Thanks for the meeting. My question is more regarding ECB monetary policy, so more directly to the ECB board members.
We will
The
agree.
question is,
We will agree on this one.
is how you guys see this discussion regarding the every other meeting approach, where you may deliver one and then not the other meeting and then deliver the other. How do you guys see that? Because it seems that you guys are pretty confident that your inflation is with a better balance going forward, and you guys are not much worried regarding the facts. So why not deliver what you guys claim to deliver? Let's say 4 cuts and then maybe wait, or maybe 3, but deliver in a whole. How you guys approach the every other meeting discussion? Thank you.
Yeah. Well, thank you for the question. This data-dependent approach, meeting by meeting, I think it works very well. One thing. It doesn't mean that you don't have your own understanding what's the interest rate path, and very much agree with you that there's so much focus on June or April or July when it's the first cut, and how big is the cut? Is it 25, maybe 50? But it's like an interesting discussion, but change of the monetary policy stance by 25 basis points won't change anything for the inflation in the medium term. So what's really matter here, this is the overall change in that particular point in time. So, but it's very important, to have this longer term or this broader view from the market perception. For the monetary policy maker, that you are approaching the period when you would allow it, when you would go for the, let's say, more restrictive monetary policy environment. But you have this privilege to make this judgment, on a meeting by meeting basis. So I think it very much depends if this is like this view if this is internal view or this is the outsider view, because outsider wants to get and to know everything. But then you are the one who sits and takes the decision. You want to have this flexibility for your decision. So, of course, I will repeat myself. It's not, for me, it's not like we most likely will cut in June. But I fully understand if we start this way, we probably and most likely will have several cuts, right? But we don't need to be that precise now at this juncture to say it should be in July, in September, it should be on the monetary policy meeting with macroeconomic projections. We are not in a rush, we're not in a hurry. So we can say we will have this moderate pace, and that's my view.
I will only complement that with the idea that if we block dates, we are not data dependent and we are not doing it meeting by meeting. So that violates in a very rude way what we've been doing. So these ideas need to be much more carefully designed. So if we are to be data dependent and meeting by meeting, it's a lot of work, believe me. It's much more work now than it used to be, because then it was much more obvious. And now it's a little bit more tricky. We need to look in great detail to very small differences. I was commenting before that these overreactions on 0.1 differences between forecasts and the actual numbers don't make much sense. But we need to continue to be data dependent and doing this meeting by meeting. There's no call for forward guidance at this stage, and that proposal clearly violates our principle of action.
Take maybe one more question, yes?
Yeah,
Yeah, I'll try to be brief. The pipeline information that we have for inflation already for quite some time points towards this disinflation process that we are really observing. Services inflation took twice as long to peak in the upswing, and it was falling up until a couple of months, maybe last month, twice as faster as than it went up. So the disinflation process was also reflected on services. But services move slower than services inflation, than headline inflation. If you look back to the data, you see services inflation very often above 3%. Even when we were struggling to bring inflation to 2% in the past. So I think we need to look to services inflation with a little bit of caution also because of that. But the ECB has been, I think, clear about the way we fight inflation. Inflation expectations never de-anchored through all this crazy process of inflation for the euro area. In some polls, we beat the Fed in terms of credibility for fighting inflation. So we are not really concerned about that. Of course, we need to deliver at every meeting. And Europe needs to, again, I've been finishing my interventions always with this statement, sorry for that, but we need to step up as policymakers and really transmit what we feel about inflation in Europe. And that's where we need to be.
Thank you. I think we're, yes, Mark is giving me the nod that this concludes the panel. Thank you very much for your questions. And it was great to have a, sorry. Can we have a question? No. Exclusive. Sorry. Sorry. Thank you.